Ladies and gentlemen of the crypto space, we're live on a Friday, June 16th at 11:47 a.m. Conditions lead to understanding of conditions, lead to comfortability, a capacity to alleviate anxiety, to not be worried. You know there's going to be volatility, and there's a variety of components to digesting these types of attributes of the system, and they have discrete or they have an independent capacity to be talked about. The path, the destination, and directionality, most importantly. So it's like a captain staring out on the water. The metaphor, I like it. The liquidity of the water. He's got a destination in mind. There's a direction he has to head to get to that destination, and the path obviously could be treacherous. You could have volatility all over the place. You could have storms, so on and so forth. The Kraken could pop up for all we know. So directionality, we're going to pop it over to the main screen and take a peek at directionality. These types of things are extremely cyclical. Now, to be honest, we have to still rely on confluence, meaning directionality is not a guarantee when we're talking about financial markets. When you're picking a destination as a captain, that's another story, so that comparison does not hold true. We have confluence suggesting a change in directionality of volatility conditions in the global collateral markets, specifically U.S. Treasury markets. Obviously, there's other collateral out there, but this is the largest, most liquid collateral market in the world, as Treasury likes to say. So, you can see cyclicality written all over this chart. What goes up comes down, what goes down comes up. Varying durations, varying time frames, but it always happens. There's almost no instance, even in this chart, other than maybe like back here, back in 2011, where there was a relatively short time frame directionality change to the downside, and then an immediate tick back up over the following couple of months. So this is about a year, give or take. Give or take. So 6 months down, 6 months up, with a break even on volatility. So this chart, I argue, is more meaningful than definitely equity index volatility indicators. Equity indexes are a knock-on effect of the global liquidity condition. So this is the precursor to liquidity expansion, and then we could look at other data that's indicative of amount of liquidity. So I like this chart as really the core of a lot of what I think about. As this chart comes down, this changes the anxiety level of actors around the world that are in control over the components of the. Bear with me 1 second, guys. Goodbye. This chart is indicative of the mentality of what the actors around the world that own the most liquid collateral index in the world. Let's put up a different screen other than my telephone logs. So as this volatility comes down, actors that own those assets are more inclined to expand the currency supply around the world. Now, the most importantly, this is a different story domestically in the United States, who's the currency producer, and the rest of the world, which is a currency consumer. And that composition is changing, and that's a whole story. And the directionality there with regard to de-dollarization, that is a long-term destination. And the path to that is going to be extremely volatile because the whole world is dependent on these dollar units of account to maintain existence, survivability. these systems persist. And the overall directionality is changing, most certainly. But the path towards de-dollarization could be 10, 20, 30 years out, and that's fine. So we have to assess the conditions of these interim, these transitory paths, these cyclicalities, to assess what's going to happen 6 months from now, a year from now. You're not allocating capital, ladies and gentlemen, based on 10, 20, 30 years out. We on this stream talk about Friday as the most significant time horizon. So the directionality screaming on this chart with a year, maybe plus, I'm not counting the bars, of a topping pattern in bond market volatility. Confluence with treasury flooding the market with however much they're going to issue for their capital raise indicates that the volatility in the U.S. Treasury market, global, will decrease. When the volatility in the Treasury market decreases, the actors are less concerned about swings in price. There's more of it, so it's less volatile, so they use it, they consume it. And there's almost only one purpose for U.S. Treasuries outside of the United States. And it's not necessarily income. And even if it is income, you create dollars using these instruments. And that has a much greater likelihood of significantly outperforming whatever rate is offered on whatever instrument they're currently holding, 3, 4, 5%. So you use dollar liabilities printed using U.S. Treasuries to finance business operations, to buy natural resources, to operate a business, uses operating expenses to finance human resources. So the directionality here screams increasing global liquidity conditions dollar denominated. Then we go over to the dollar from a Forex perspective. The dollar from a Forex perspective, there's plenty of reasons from a resources perspective, disruption of supply chains as well as mining and oil, that could reverse directionality or allow it to continue to the upside. But we've waited 6 months. We have 14 days left for the next candle post the blow off top at the end of 2022. And it closed below the open of H2 2022 candle, which is this candle right here. So from a technical perspective, we have confluence, the follow-up candle of the most previous candle structure is confirming that this is a shooting star. And this isn't like the daily candle. You're not looking at daily candles here. You're not even looking at monthly candles here. And even from a monthly perspective, there's interesting confluence because it's below the TWAP, and we have previous support or a breach of the TWAP, and it fell right below, and the TWAP has been holding as resistance for the last couple of months. But from a 6-month perspective is what I'm most interested in. So we could see this come down to the TWAP. That's fine from a 6-month perspective. Do you know what happens if move directionally changes to the downside, responding to the global treasury market being flooded with securities? And if the DXY just comes down to the 6-month TWAP, 97, what does that do to the composition of global liquidity or the availability of global liquidity? It would be absolutely a flood, an absolute flood of available liquidity, countless trillions of dollar liabilities from a global perspective, chasing or searching for outperformance relative to the yield on U.S. Treasury instruments. Now we can look at the bond market and assess the interest that the world has in that 4 or 5 whatever percent it stabilizes at. But we also have to consider there's less interest in the world accumulating those assets. So they're going to purchase them because, one, they need them. They need them for their balance sheet composition. They need them for collateral. You're not collateralizing dollars, you're collateralizing yield-bearing instruments that are relatively risk-free because they're going to get paid on nominally, not risk inflation adjusted. So I'm curious in the next 2 years, 2025, 2026, the interaction between the DXY and the 6-month TWAP. Let's go back to the monthly real quick. So we're below the TWAP on the monthly. We don't know, we don't have any indication where a bottom is, and I'm not going to be looking to previous highs. We're already below previous highs. We're flirting with previous highs in 17 and 20 holding as resistance, invalidating the entire dollar move between May of 22 and now, which is very interesting unto itself from a technical perspective. So between now and 2025, 2026, directionality indicates a serious increase in global dollar-denominated liquidity. And that's obviously considering a foreign currency, just its relative dollar value in purchasing power terms. Just when the dollar comes down in value, the purchasing power of foreign currency units increases, and that plays a role in productivity and capacity for those currency units to have the effect of when you spend money of any currency, it creates an effect, causality, and that effect is more meaningful, more purchasing power when the value of the dollar relatively decreases. So that's where we are. That's not the crypto market price point. That's not the equity markets and what they're doing. Those are all knock-on effects, and those are all incredibly sensitive to sentiment, to regulatory narratives and political narratives, and that means nothing to me with regard to the way I look at conditions to find my comfort. What I see in the data is directionality. I see the destination, at least from, let's say, a 2025, 2026 time horizon. So I see the destination. I'm not really looking out to 2023, 2030. It gets increasingly speculative from that perspective, but that's just frankly exciting relative to the directionality that I currently see. But we'll check back in 25, 26 especially as we get to those dates to assess and improve and refine our outlook into 2030. But this directionality is screaming increasing liquidity supply. And it's not a little bit of an increase in liquidity supply. We never got to, to tight liquidity conditions from a Forex perspective compared to what happened in 2000 and what happened in the middle of the 80s. Those were tight Forex conditions. What occurred at the end of 22, maybe I guess at the peak of tightness in 2022, it got close to maybe 2000 conditions. But look, it was a blow off top. It didn't even last a year. It didn't even last 6 months. It blew off to produce a shooting star. It was invalidated. And now we're 14 days away from confirmation of that invalidation. So what happens when you have increasing liquidity conditions? And now it's the exploratory process of knock-on effects. And knock-on effects are the markets, the crypto markets, the equity markets. So whether the equity markets smell all of this or not, I don't give a shit. Whether the crypto markets smell all of this, I don't give a shit. I just care about directionality. I know the path is going to be ridiculously volatile because of all those sentimentalities that we just discussed, and regulatory complexities and political complexities, but they're independent in many regards. They're loosely coupled pressures. But if the liquidity conditions over the next couple of years are to significantly improve, that's generally appreciative of all volatile assets. With extra capital, people are allocating to things they think will outperform. Now, this is not reflective of the general public and how relatively broke folks are. Unfortunately, that is independent. That is an independent attribute. This is not, we have not discussed the path and the volatility, particularly with regard to commercial real estate and student loan repayments reactivating. Those dry up liquidity and are capital destructive. Will that be domestic? Because we're really actually, when you're looking at Move and you're looking at the DXY, we're really talking about international liquidity conditions from a global perspective, not on a country by country basis and the nuances of what's going on internally in each country, even domestically in the United States. So we could have those extreme complexities, those volatility events along the path with regard to commercial real estate and student loan repayments, but the liquidity conditions are significantly improving, which means the folks that have access to the liquidity, you know, you can have an entire conversation about liquidity itself and who has the money and so on and so forth. But the liquidity, the cash, the currency units, the liabilities have increased significantly, even domestically in the United States. We just talked about international liquidity conditions. Now we're talking domestic. Look at the domestic liquidity conditions. They have increased significantly for the entirety of 2023. Since December of 22, liquidity conditions have only improved within the United States. So we just described directionality for liquidity conditions globally over the next couple of years, improving, and liquidity conditions in the United States have been improving for the last 6 months. So the U.S., the Fed, and the Treasury and politicians are in control in many regards over domestic liquidity conditions. That's their mandate, to govern this population. And unfortunately, the rest of the world is caught in the crosshairs as knock-on effects of our domestic policy goals. But there's also, I would say, many would argue, that commercial real estate and student loan repayments being potentially extremely deflationary. We'll see how these regulators respond to that type of path volatility. They know that the directionality of the system inside the United States is deflation. It's screaming everywhere. So the only way to compensate for deflation is to improve liquidity conditions artificially. And then the complexity, the burden that the regulators have is how to distribute that liquidity and to whom and what effects those liquidity improvements will have. Now, with the mistake they made, or arguably whether it was a mistake or not is another story, but they distributed liquidity to the general public in 2020, which put a bid on consumables coupled with supply disruption. So that's very obviously where consumer price inflation came from. The extent in which the liquidity provided to the general public in 2020 exacerbated consumer price inflation is probably something for scholars to debate. But it certainly did, rather than did not, exacerbate consumer price inflation. Now, for instance, if they distributed all that capital in 2020, but supply chains were just fine and the world had a capacity to increase supply, there would be zero consumer price inflation. So liquidity is not as simple as, oh, they printed. Oh, they're printing. corrupting and they're causing the inflation. No, that's not the way inflation works. That's not the way consumer price inflation works. And that's not the way elastic currencies work. They need to increase the supply. They need to decrease supply depending on conditions. Now, I've said a lot during the stream. That's another story. It's another story about that with regard to getting humans out of the equation, letting software run those types of processes. I'll leave it at that. But what do I see? I see disparity all over the place. I see liquidity conditions improving domestically in the United States with the general public crushed under debt and lack of excess liquidity. Excess liquidity means past bills and expenses. Folks have very little discretionary capital that they could use. People are broke, but the liquidity conditions are extremely loosening visibly in this chart, and that's going to have an effect on asset prices. And now real estate is another story. That's a completely different story as compared to highly liquid asset prices, particularly in the markets, uh, d- digitally liquid assets, something like that, where you could point and click and move dollar liabilities and swap them into and out of varying asset types. That's the asset class that's sensitive to liquidity conditions. And real estate is, of course, but real estate is so fucking slow. All those processes of the lawyers and the paperwork and all of that bullshit makes it a lagging responder to liquidity conditions. Anyhow, all right. Well, we go look at some crypto charts too. This takes months, USM too, but this obviously came down significantly. I think this is going to have to go up significantly, and this is also a lagging indicator. M2 is a lagging indicator. First, you got to loosen credit to allow enterprise to even begin to expand this chart. This chart is a lagging. USM2 is a lagging indicator of liquidity conditions. Interesting. Raul's in the house. RAAC. Hello. Koji. Good morning from Dominican Republic. I got to get down there and take a vacation sooner than later. My whole family's from there. Dirty Sanchez. Good to see you. A pleasure. Still spreading the rational thoughts. This is the most important time to remain rational. This is some. It's difficult, but I've been through this and I've learned so much over the last couple of years that look, the whole stream today is about directionality, path, and destination. The directionality is clear. I talked about it all stream. The path we expect to be ridiculously volatile, and the destination is more obvious than ever. And that's not the destination of technology consumption. It's the destination of liquidity. Liquidity is everything, and liquidity is screaming that it will increase internationally over the next couple of years. My man, rationality. Sergio, present, assume, good morning. One curious view. Brian, I visited the Fed yesterday. I see the Money Museum. I can only think about how crypto kills the need for any of it. No, it doesn't. Not necessarily. So there's an interesting, the whole Bitcoin narrative here. I believe it's still up. Yeah, Chris made a good point. There's a lot of sentiment that Bitcoin is to fight the system and Ethereum supports the system. A rebel, to revolt, to protest the system. I don't know. And I don't have the answers to these questions, but it's important for folks to be granular about what they are. And he's right. He's almost always right. And that's uncomfortable for many. But if you have the patience and the capacity to look at things with, suppressing emotion to a degree, what his posts are very meaningful. And he's right about Ethereum. But I don't see it as a bad thing. I see Circle and Tether are meaningful to the global financial system. in regards to everything I just described about liquidity, about dollar liabilities, about debt and debt servicing and management of debt and all this stuff. It is what it is. Is it bad or good? It's an endless debate, and it's very subjective. But it's not going anywhere, and I don't. Both of these systems aren't going anywhere. And many will choose Bitcoin for its merits, and many will choose Ethereum for its merits. And I have a high opinion of both these systems for a variety of reasons, and could debate both of them with anyone that has questions for just basically a perpetual, indefinite debate. And I just, it's important to not get tribal. That's a word often stated in social media. And to be comfortable with these things and not let that anxiety of not having a clear answer for yourself. You will find the most comfort when you answer your own questions, especially when you answer questions of others. But when you can answer your own questions, you're not nervous, you're not uncomfortable, and you are accepting of conditions because you understand them. And you understand these conditions say directionality, path, and destination. So you're comfortable with the reality of what you're dealing with. So it's very meaningful. Hope that helps. Um, so it's not necessarily the case that the Fed is bad. I think obviously political corruption and stuff like that, and malinvestment, and the ridiculous fraud, and the misallocation of capital is ridiculous. But that's kind of separate and apart from currency units, collateral, debt, enterprise, leverage, a capacity to borrow against the equity that I have in my business. And that's the system in which I find powerful that Ethereum is offering. And that's what I see as probably the greatest investment opportunity available in all markets. Liability printing. And you can't do that with Bitcoin. I mean, Bitcoin reduces to a very simple system of collateral, outside money collateral, which is profound and meaningful. Has a heck of an attack surface. Bitcoin has a very big sovereign attack surface, particularly because proof of work mining is obviously centralized. It's centralized aside from who's hashing and then the mining farms. Um, but when you have to actually connect to the power grid, you have to have a building, you have to have equipment. So it's centralized in that you could the in response to political action, authorities can go into a building and seize actual physical equipment, eminent domain, and nationalization. So that's an extraordinary attack surface. That's not the case necessarily of proof of work, albeit proof of work, the government could just buy all the Ethereum with printed money. So, which has a variety of knock-on effects, increasing liquidity in the system because they created the currency units anyway. But there's an attack surface there. It's imperative to understand these attack surfaces and to be comfortable with them. And I see just incredible risk with these systems. And how do I measure the risk of these attack surfaces with Bitcoin and Ethereum as compared to the risk of a traditional enterprise? I've had investments in traditional enterprise where the board, the people, I did my due diligence. They were interesting people. I saw their personality. I saw their history. I saw their education. These are people on the board. I saw their business tactics and their ethics. And I've seen great business just fail, even though they did $1 billion capital raise. And now in hindsight, the risk profile I assign now is because humans were there. Crypto and smart contracts and this whole deterministic nature of a smart contract deployment, immutability, so on and so forth, allows me to find comfort with these positions and allocations because I'm eliminating humans from the equation. And that significantly decreases the risk profile of an enterprise. Anyway, interesting. I recommend anyone to go see for themselves. Yeah, it's probably very interesting, at minimum from a historical perspective, certainly from an architectural perspective. That's pretty cool. Good stuff. Year-end BlackRock ETF entering crypto. Sure, yes, it is. There's, look, what Chris said with Bitcoin in the in the in BlackRock's um, proposed structure. They reserve the right to choose whatever fork they want in the future. So they could easily choose a proof of stake fork if they want. And it explicitly says in the documents, which Chris has been talking about actually, that it's not, which that's a reality. And that's interesting because you can see that's an attack surface. BlackRock goes live, that goes through the roof, and then they propose a proof of stake fork of Bitcoin. That's a very interesting attack surface considering the scale, scope, and reach of BlackRock and how much capital they could potentially receive from the investing public. Interesting. Killis, good morning. Tapsy, yo, have a nice holiday. Thank you. There'll be no streams next week, ladies and gentlemen. I'm taking a couple days. I should be able to get on Twitter a little bit. Feels like BlackRock makes their move to destroy crypto from the inside out, like they probably did with FTX. That's what I was just referring to, and I hope that that reality is understandable. It shouldn't be discomforting. Just understand it and process the risk profile accordingly. Assume that was a bar. My man, maybe you're talking about the move bar, because that is one heck of a bar. One, that's a blow off top, and the DXY bar, that's a hell of a bar. Maybe that's what you meant. Shinzo, are there any circumstances that would invalidate your bullish thesis on dollar liability printing? Deflationary implosion. If we allow, like a significant contraction of capital around the world, like if the U.S. Starts a war and they allow 1,000 banks to implode and serious austerity in the United States, where the capital of those banks, like the depositors, actually lose trillions of dollars, and the stock market tanks 40-50%, and there's no intervention. Yeah, that invalidates my bullish thesis on dollar liability printing. That means the narrative changes. That means dollar liability printing, they don't want it anymore. It'd be a war against the non-banks and the Eurodollar system. In that scenario, the reason it's war is because that would be absolutely collapsing of international financial conditions. It would just be absolute chaos, crushing. There would be depression, global depression, um, if the system is not supported. And and it's interesting because the directionality of the system is that. And the only reason we don't enter that deflationary implosion, which is recursive, is because of policy intervention to adjust availability of liquidity such that debt servicing can continue. If the debt starts to implode, it cascades throughout the world. There is no bottom. And that's what happened. That's what started to happen in 2008. The debt started to implode and it was taking out big banks, and the world is invested in these banks. And once the collateral starts to evaporate, the whole system is based on rehypothecation of the same collateral over and over again. So there's no bottom to the rabbit hole. It all just evaporates into nothingness. So that's what invalidates my bullish thesis on dollar liability printing, which is basically which is basically an abandonment of domestic policy to maintain the status quo, to avoid a crisis in the retirement population, which is probably a humanitarian crisis in all regards. And that's just domestically, because obviously all of this causes international humanitarian crises for the whole world. But that would be U.S. domestic policy completely abandoning its population. You don't avoid a depression but if the banks start to fail. So by saving banks, you're saving the collateral, therefore you're propping up the entire system, which means liability printing is the best business on the planet. That's the big banks. That's what the world is currently fueled by, the capacity to print liabilities using collateral. Hope that helps. Curve bottomed, looks like it, 61 cents. The structure of this chart I still love. There's invalidation, obviously, if we start to have a significant restructuring of this, which is a very obvious inverse head and shoulders pattern right now. Significance of it as an inverse head and shoulders, you only know an inverse head and shoulders once it's confirmed, which means a breakout to the upside. Up here, buck and a quarter, buck 50. Probably need to get to a buck 60, buck 70, and you could have a confirmation that this is the most incredible reversal pattern, bottom reversal pattern ever, spanning from June of 22 to now. This is a 1-year inverse head and shoulders, speculatively, potentially. But structurally, I love this chart. If anything, this has overtones of an Adam and Eve pattern, inverse head and shoulders. If you zoom out to the monthly, this thing is just been bled dry. And it doesn't mean much from a functionality standpoint. I don't find much interest in the asset from a significant appreciation standpoint. Look, in the next bull run and stuff goes, 100x, 1000x on the money. If this goes 5x on the money, 10x on the money, if it gets to $8, that's crazy. So you gotta have very different expectations for an asset like this as compared to other potentially hyper appreciating assets. I don't expect this to hyper appreciate like that. In fact, hyper appreciation like that, you expect obviously a normalization and a return to the mean, a mean regression. And that's what happens with all the assets time and time again. So anyway, I don't mean to ever encourage folks to allocate capital to things. I just talk about the things that I'm interested in, and I obviously that I know has an effect on folks and what they think, and I continue to think the same way. I just see Federation components coming in left and right. I think there's 4 on the just beyond the horizon, Curvance and a bunch. There's a bunch of more Federation participants coming, and I expect that to continue, and more and more and more, because that's what federations do. We've seen that throughout history. Bitcoin holding steady. Not too fond of the chart structure, albeit it did hold from a moving average perspective above the monthly TWAP. That's probably what's most interesting. So it was a breakdown below the TWAP, a breach above the TWAP, and now we just tested previous resistance flipping support. That's where we are. I've been looking at the market cap for Ethereum rather than like a dollar pair, but it's comparable. Maybe a little more granular in the market cap perspective, but same thing. Break down through the monthly TWAP, break out, retest. Except here we have the 10 SMA in the monthly. No 10 SMA in the monthly for Bitcoin. Maybe there's a Bitcoin market cap. Crypto cap. Yeah, there is the 10 SMA. No, that's the TWAP. There is no 10 SMA. Why is there no 10 SMA in this chart? 10 SMA in this chart, but I have a 10 SMA in Ethereum. Anyway, Ethereum denominated in Bitcoin is still this ridiculously epic triangular compression. This wedge is fantastic. And Directionality is still screaming on this chart for Ethereum to outperform Bitcoin over the next years. I'll leave it at that. Hope that helps. There's no real guidance. It's not for me to say actions to take. It's for me to describe what the hell's going on in the market so folks can be a little bit more comfortable and not freaking out and allocating to things that are systemically meaningful, that are financial infrastructure, that have interest from the status quo financial system. They're like, oh shit, that's freaking crazy that we could do that. And that's meaningful. And that's the hallmark of a good investment. It's not speculative about price. You don't allocate capital based on price. So this is not, like fundamentals. You invest based on fundamentals. Maybe that is what I'm describing, the fundamental capacity for an enterprise to be significant. And then you have to contemplate entry price, current state of the market, liquidity conditions, whether you're at the top or the bottom. So fundamentals probably mean the most in market conditions like this after the liquidity drain. And fundamentals mean the least when liquidity is extremely high and assets are moving irrationally and just capital is being thrown around everywhere. That's when you could really just play technicals, and folks are just looking at charts for entries, for the cyclicality of price action. But so that's probably the best way to describe a good part of my sentiment is when the liquidity is drained, it's fundamentals that you're looking at. And when there's ample liquidity, then you just play in technicals. Last question, I'll wrap it up. Hey, I'm also touching grass next week. Need the break? Well done. Everyone, relax, unplug. Everything's good. Everything's fine. Everything's interesting. Look forward to the volatility because the volatility says that there's price discovery. The volatility allows people to actually assess what the hell the value of these assets really are. The volatility is what pulls back the curtain and reveals what is truly significant and what is utter bullshit. 23 people in the stream, 12 likes. I appreciate all of you. Thank you for joining. Hit that thumbs up button. Friday, June 16th, 12:29 p.m. No streams next week, but I'll hopefully see you on Twitter. Tell everyone to subscribe. I will see you ASAP the following Monday. You know the deal. After party on Discord for the most rational community in the entire crypto space. Peace.